Good afternoon, everyone. So we've hit the 100 mark. So I think it sounds about right that we start off and respect everybody's time. Rest of the folks can join in. I would like to welcome all of you to this session, like webinar that we are hosting for understanding the aspects of portfolio valuation of portfolio of AIFs. Post the various circulars that came out from SEBI since June 2023, defining the standardized approach on valuation of AIF portfolio, and subsequently on 19 September in 2024, when some modification in aspects of valuation were also introduced in terms of a clarificatory circular on valuation. We thought that it was apt, given the clarity required around the IPEV guidance framework and the IPEV guidance note that was made in consultation with various independent valuers for the industry, tailoring it to AIFs in India. We thought that it was necessary to do a webinar. We have here, so I would like to welcome the two esteemed panelists on the webinar. We have Mr. Rishi Aswani and we have Mr. Sarvesh Palekar. Rishi is Managing Director, Holihan Loki, and Sarvesh is Senior Vice President at Holihan Loki. Both of them have extensive, almost 2 decades of experience in valuation advisory, and their expertise lies on the unlisted side in terms of valuation advisory to private equity funds, venture capital funds, and funds running various strategies as part of various portfolios that they've managed. Many of you would already know them. They are the ones who actually helped IVCA carve out the IPEV guidance note as well. So we would like to thank both of them that they have actually taken out their valuable time to spend with us and give more clarity in terms of aspects of valuation. So without further ado, I would like to welcome both of them and hand it over to them to carry on with the session. Just one thing which I would want to inform you in terms of logistics is that we will divide the session into a portion in which both of them are going to delve into the details or technical aspects of valuation, so that clarity is obtained from the perspectives that they share. And post that, we'll have an FAQ session around 20-25 minutes or so that all of you could actually get your questions answered. I would encourage all of you that while the session goes on, you could actually write into the chat box and all your questions with your coordinates as well, so that if we are not able to take those questions, we will write to you later on after the webinar. So do put in your email ID, name, and fund name as well with your question, so that we are able to get to you in terms of a response if we are not able to do so within this webinar. So with that, over to you, Rishi and Sarvesh, to take us through the detailed aspects of valuation.
Thanks very much, Ron. Thanks for the kind introduction. Hopefully I'm audible.
Yes.
Okay, great. Okay, thanks very much for taking out the time for everybody that's joined this webinar. Appreciate it. We plan to cover the IPEV guidelines in its current form. Also, then get into some asset strategies. We've picked growth equity and private credit here to talk about. We could get into real estate and infra on the questions in the Q&A, but given our time constraints, we're focused on equity and private credit at the moment. We've also left a couple of hot topics towards the end, and then we'll open it up for Q&A. So with that being said, maybe I'll just start sharing my screen. Sarvesh, if you could just bring up the slides. We'll just walk through this quickly. So some of this will not be a surprise. The IPEV valuation guidance note, as you guys have tracked, I think what Rahul was explaining, just very quick introduction to both of us. We both work for Holihan Loki. It's an American investment bank. It has presence on the ground in India, in Mumbai, and in New Delhi. We have a separate group that does investment banking. We have another group that does restructuring, and then the group that Sarvesh and I represent is known as the Financial and Valuation Advisory business. It's actually where the firm had its origins 50 years ago. And portfolio valuation is a notable business that we do globally for sponsors in all parts of the globe. So a little bit about my background, happy to share that later, happy to be reachable, at a later point for Q&A. So we can maybe move it forward. Great. So this is where I like to start when we start talking about IPEV, because I just want to demystify a couple of things. Um, we've been doing private equity valuations, private capital valuations, I should say, in India and around India for more than a dozen years. And it's not a contest as to what the deal team knows and how what the valuer knows, and then kind of a contest between who's going to get to this kind of magical fair value number. Really, to come back to the goal, right? The goal is to provide useful information to your LPs and meet your audit and regulatory requirements, right? And I'll double click on some of these concepts when I mean useful information, right? The question that we need to ask is what do LPs expect? What kind of standard do they expect that's comparable across the world? And I have it slightly below on the page. If you look at the new Indian GAAP, which is Ind AS, and you compare that to IFRS or US GAAP, right? So it depends. It doesn't matter where you raise your capital. Limited partners almost universally expect reporting to happen on a concept known as fair value, which is an accounting concept. But if you expand that, which is in the middle of the page, why is it important to understand the definition of fair value? I think you need to start from the very definition of fair value, right? And that will kind of touch upon a lot of the aspects that we're going to cover today. And then finally, I think the current state of affairs, which is in our observations around the industry in the last dozen years, we have observations as to where are some particular areas where, we perceive areas that could be, developed and improved, and not only in the analysis, but even in the documentation, and then certain asset strategy specific know-how, which we think shouldn't necessarily be superimposed from one strategy to another. So we'll move forward. We'll get into some of these. Governance is an area that I like to talk about, because this really is the starting point for how to think about kind of the fair value process, right? The aspect that I'm trying to cover is the fair value process and the valuation process needs to consider all of these factors, and some of them are interconnected. Applicability, right? So the question we're asking is, this is an opportunity for the fund to think about actually putting down on paper what it is that it's looking to achieve. So, and there are benefits to putting it down in writing, because then you can kind of develop this, revisit this every year, and improve the process. So applicability, what do we mean by that? We're talking about policies that need to kind of cover the universe of securities and strategies relevant to the fund, right? That should be clearly articulated. When we talk about governance, we're talking about clarifying the role of each party in the valuation process, right? Who is going to be kind of the maker, who's going to be the checker, and that's where you get into even on transparency, right? It's not just the maker checker, but who's going to finally determine the NAV, take the management ownership for that. How are we going to have a separation of that role from the middle office? What is going to be the frequency of that valuation process? How are we going to stay on top of that information? Of course, that kind of dovetails into responsibilities, and finally a set of final policies and procedures, right? And in the AIF space, I think everybody is aware that it's mandatory to involve an independent valuer in the valuation of the portfolio companies, or the portfolio investments, I should say, whether they be equity, credit, or in any other form, right? So all of these are an important starting point, because as you think through all the steps, it's essentially what we're doing is helping investors on that portfolio valuation process. That, for clarity, that means after the deal has been made, right? And so the different responsibilities will kind of demonstrate independence as well as rigor around what it is that we're tracking. We'll just move forward. Now, I wanted to kind of demystify a little bit of IPEV, and I think that'll be helpful, because when people look at IPEV, they're like, what is this, guideline, and am I supposed to go through it in detail? I'll say it's not everybody's favorite reading topic, but it is a pretty thin book. It's no more than 70 to 80 pages. And I think rule number one for everybody involved in this process, that takes some kind of responsibility in this process, is to really read the IPEV guidelines entirely, right? These are guidelines that have been put into action through a variety of stakeholders, and this has been kind of like a snowball gathering, more mass as time has gone on. I think the history of IPEV is actually a very important thing, because it started in 2005 when a number of different private capital associations said, let's have one one guideline that we can look at for best practices, and something to point to that kind of helps us think through. But the truth of it also, in terms of the history, is it was primarily it started in the private equity space. Just like I think it's evolved in most geographies. It started in the private equity space, went to earlier stage equity investing, then started building on other strategies. Even if you look at the book today, private credit is a page and then some in the appendix. Infrastructure is just a paragraph. Real estate is really just a paragraph. So I think just understanding the history of IPEV, that it's expanding to cover all these classes, is also very important to understand, right? The second thing is something I hear often, which I think causes confusion, is, hey, is this a replacement? Can I use IPEV in a way that kind of talks about it as a substitute to IFRS or US GAAP that my LPs want? And the answer is it's not a substitute, right? It's a framework. What we're talking about in US GAAP, IFRS, Ind-AS, these are accounting standards, right? IFRS is a framework that sits on top of them. It's something that kind of provides guidance. It looks at exactly the fair value standards. It looks at language in the fair value standards, and then it pushes those best practices in the private capital space, right? Now, for some of you, it may not be much of a shift. You may have already been using some of these concepts, maybe informally. Maybe you are calibrating to fair value price discoveries. Maybe you are putting together the way you think about multiples, the way you think about discount rates. Maybe you are using a lot of IPEV already, but still it's important to kind of look at the book and take a look. So the question I obviously get asked is, listen, obviously we have like so many investments that have happened in India. You've had more than 100 billion that's been committed to the AIF space, maybe a couple of 100 billion outside the airspace globally. How we got by so far without implementing IPEV? And so, I don't think it's a binary answer, that it's great or it's not doing great. But I think some things that have come through, and I'm going to talk through them on the following page, which is that, investors expect to see a certain amount of rigor and apples to apples comparison using that fair value standard. And I think that's an area certainly for the industry where we could kind of further mature and further evolve in certain processes, right? So looking at the page, adopting and implementing IPEV, what are we really talking about, right? The first one I covered already, which is the implementation of valuation policy. I think that was even part of the old, from the 2012 AF regulations. Even today, there is a requirement to actually have policies and procedures. This is something which I think we could be doing a little bit more of a bespoke job about, sitting around it every year, updating it for how we've seen results backtest compared to our valuation process, um, and not just simply copy somebody else's valuation policy and then kind of amend it to kind of match ours. It really has to be like to what I mentioned, to all the steps that apply from applicability to governance to transparency to responsibility, right? So happy to talk about that in a separate forum. But that's certainly an area I think that can be improved. That's a document that you can give your LPs and say, this is what we're following in-house, right? And it's more, I should think more of it as a governance document, because from a know-how document, you already have now certain standards that speak exactly to private capital valuations. You don't need to make that valuation policy, how to value. The second topic that we'll talk about, which I think is an area of, another area which causes some confusion, is the application of the price of recent investment. And this has been a long-standing practice where marking to the last round was a bit of a given, especially in the earlier stage where there was a lot of subjectivity and there was a lot of hesitation about sharing more information. I think the price of recent investment was used as a standard, and especially a lot of valuation policies kind of had price of recent investment, in usage for about 12 months or more. IPEV never intended that. IPEV actually, the last time it said you should rely on the price of recent investment in a more formal manner, it said it was 2015 when it said you should, it's applicable for a limited period of time. It never said 12 months, it never said 18 months, but somehow around the world, I think people have been using it for 12 months. And then IPEV basically got a lot of feedback that a lot of valuation policies were resulting in outcomes that were not in accordance with fair value. And there's always a shock event somewhere in the world, because these are 40 now private capital associations that have endorsed IPEV. And so they started saying things like, we have market shutdowns, you have Brexit, you have other shocks, you have trade wars, and you had COVID, you know, and now, using a val policy and just pointing to that and saying, I don't need to do anything for 12 months, doesn't hide the fact that there is volatility, right? So the application of price of recent investment is a topic we'll again get into later in one of the hot topics. But it is certainly something that has evolved. And I think a lot of funds are still getting to terms with the fact that they need to calibrate their models to price back to a round that meets fair value. So that's an area of improvement that I would definitely point to. That gets me to the next topic, which is the lack of calibration. And it's not, a concept that IPEV is introducing, ironically enough. If you look at the fair value standards, and I know some people will say, hey, look, we're set up as an AIF, which is a trust vehicle in India. I use Indian GAAP. But if your investors need to compare your results to, the results in other AIFs, fair value is the guideline that gives you that apples to apples comparison, right? So regardless of accounting standard, if you look at US GAAP, IFRS, Ind AS, and you just open the standard and you look for the word calibration, it is there. It is there, and if you are calibrating from a transaction deemed to be at fair value, it's a requirement. And oftentimes you look at calibration and say, well, this was more than 12 months ago, or this is something that is no longer applicable. Well, we need to kind of look at that, the details behind the transaction. We need to get the background behind the transaction. A lot of time is spent on understanding the transaction. Who was involved, how much new money, how was the price discovery done, all those kind of aspects, because it's a pretty high bar, which globally across the world, calibration is not just a requirement, but is a very helpful tool in more ways than one. So we will get to that in this conversation. And then finally, as I said, the strategy specialization. And I think that's important. I think, I'll tell you, I've been in the valuation space for 20 years. I used to be a corporate valuation specialist. And then 7 years later, I started working for a fund. And then within the fund, I started valuing private credit. It's different. It's different. You need to have specialization in credit, and then kind of opposite credit and more of the equity work. I've noticed that some of the concepts people kind of challenge because they may not have got that asset strategy specialization. That's an area that is certainly an area where I would recommend people spend more time and ensure that they're heavily trained up on those areas. So that's a lot of background. I talked about it. Now um, we can move into some more kind of guidelines and some helpful tips on valuation methodology. But essentially, you need to look at IPEV in a way that when we were talking with IVCA and SEBI a year ago, we realized that the feedback that was coming back from the industry said, look, IPEV is slim. It doesn't have guidance for us in certain asset classes. What do we do? Now, IPEV is perhaps the most popular guideline overseas. It's not the most detailed guideline. There is a very detailed guideline in the US that came out 5 years ago from the American Institute of CPAs. So, this is a place where professionals like Sarvesh and I exclusively operate. And so we kind of help the IVCA to beef up certain guidance note to IPEV, and then did a bunch of Q&A and worked with other valuation firms and other stakeholders in order to put together this guidance note. So I'm not going to get into the details of that. That is something that I would recommend everybody to just kind of run their eyes over. And again, IPEV is meant to be a guideline, a best practices guideline. It's not a how-to book that has examples and it's deliberately made in that manner. It's made in a manner to provide a handbook on how to think about the frameworks, because they made a conscious choice to not have examples in that. Whereas if you look at the American Institute of CPAs, the AICPA practice guide, that's 600-700 pages thick, and there they made a conscious choice to include hundreds of pages of examples, of which I would now today argue, those were written in an era from 2013 to 2018, where the interest rate was zero, and now certain things haven't aged as well. So, both these guidelines, regardless of how thick they are not meant to be authoritative. These are principles And so I'm not going to get into chapter by chapter of IPEV. I think it's going to be more or less straightforward. I'm happy to be reachable if somebody wants to talk about it. But essentially, I'll put some pages across to you and some access strategies, as I mentioned, across to talk about it, right? And so this is very simple, visualization of, what it is that we may be valuing, and some of the commonly used valuation methodologies. But I think IPEV will force you to think about certain questions, right? Especially starting from the top, right? I mean, someone would be guilty of reading them off the page, but what's the investment thesis and what's the strategy, right? Um, are we thinking about, the instrument that we're investing in this context is really the question, right? Did the transaction represent fair value? And there's obviously a qualitative assessment on how to think about whether it was an orderly transaction between market participants, without any forced sale connotations, and then we think of it as of that current date, right? So we think through all of those questions, and then if we do meet the standard of fair value, we're required to capture then, a model that kind of backs into unobservable inputs, and then you kind of refresh the market data in it. You refresh the market data, you refresh the underlying company data, and then you ask yourself the question, which is on the third bullet, right? How is the investment performing compared to what we underwrote, right? And then those are the questions that you need to kind of step into the shoes of a market participant and ask the question, well, this is an investment I would have to hypothetically exit today. What is the price that I would be willing to pay for it, right? That's the question. Not what would I like to get, but what would I be willing to pay for this? So, those are some considerations you need to ask. The other questions, obviously, IPEV gets you to kind of look into, are you looking at a complex capital structure? How does that impact equity value? Investors are negotiating for rights and preferences and privileges. How many of those can be put into a MAT model? How many of those need to be thought of as kind of soft power, whether it's a positive or even a negative? Do we have the right frameworks around the company analysis, right? Oftentimes people look at the comparison to, not just their company's performance, but also, the comparable companies. Or, at times we look at the instrument and we're not looking at the company level and the fundamental level. In case, I'll give you an example of debt, right? If you look at the debt part of this page, you can see it breaks down into non-performing and performing. I'm not talking about a particular strategy. I'm talking about the state of the investment, right? So the question is, how likely is there a high likelihood that the instrument is expected to be performing, or is there a high likelihood that the instrument is expected to be non-performing? So, right, these are the questions that we're asking, and then that determines actually the valuation methodology, right? Rather than do it the other way around, saying, oh well, it's debt, right? I need to take like a discounted cash flow, right? Then there are other considerations. Did we invest in more than one security? Do we hold debt and equity in the cap structure? What is the level that we aggregate this investment at? Are we thinking of our investment IRR in those terms? And then finally, you get into like, what primary valuation approaches are applicable, and then you consider them and weigh them. And then that's just general kind of valuation, methodologies and theory, which I think most people are familiar with. What's a DCF and a market approach, and just speaking colloquially, and a net asset approach, right? So those are some of the things that IPEV will have you double click on as you kind of make statements on the fact that you're kind of following the requirements. If you think back to the SEBI circular has particular guidelines on, it starts off by talking about what guidelines are applicable to listed securities. And then it talks about unlisted, and then within the listed bucket, non-traded or illiquid. So all of that is bunched together. And so unlisted, non-traded, illiquid, all of those have been deferred to the apex industry body, in which case it's the IVCA, in which case the IVCA has endorsed, IPEV. It's something that I've been chatting with them about since 2015, 2016. And it actually happened even before the SEBI circular on valuations. So that's how we're kind of, that's the kind of universe that we're approaching here. So maybe we'll just move forward, and I think we'll get into some more considerations, and I'll maybe turn it over to my colleague Sarvesh to chat about some considerations on private equity valuations, then I'll pick up another one post him. Go ahead, Sarvesh.
Sure. Thanks, Rishi. I think one of the main things that Rishi set the tone for was in terms of private equity valuations, right? So this is not a valuation masterclass, but we are going to talk about how to sort of tailor make your current application or current processes to be in line with IPEV. So one thing I would like to specifically emphasize on is the fact that IPEV does not give you valuation methodologies. Your base valuation methodologies remain the same. That would be your DCF and market approach. What IPEF does is it adds a framework on top of it, mainly to help you adhere to a investor's viewpoint in terms of valuation. So one thing to always be mindful of is that you as a finance controller or the CFO's office are looking at an investment post the investment is done by the fund and tracking it over the life of an asset. One of the few things that we have seen over the last few years that we have discussed with multiple funds is that most of them uh, tend to either mark their investments to the recent round of financing or hold it to cost unless there are major changes. So one of the changes from IPEV that comes across is the concept of calibration. Rishi did touch upon it a bit. I just want to highlight that calibration is not a valuation methodology in itself, but it's more like a framework which is attached to your valuation methodologies. For example, if you have a market approach or an income approach, rather than valuing it as of date, what calibration implies is that you back into the value that you paid as of the date of your investment, build a framework around it, backing to that value, and then see for either the market changes or company specific updates to come to the value of the business as of today. Now, some of the key aspects that IPEV talks about and which are also a part of other methodologies is that uh, from a portfolio valuation standpoint, it's not the value of the business that you're looking at, but the value of your investment. So your unit of account plays an important role. So as of the date of investment, even if the company has a most recent round of finance, you would have to look at it whether one, it was a fair market, fair value transaction, and if it was it in the same security as the security that you hold? If either of the conditions are not fulfilled, you'll still continue to calibrate, trying to see as to what is the value for the security that you hold. Now, just want to reiterate the fact that your valuation methodology still remains a market approach or the income approach. However, to arrive at the value of your holding or your security is where you would tend to use a sophisticated model, which can be an option pricing model if the rights and preferences are highly weighted, or a fully diluted or a common stock equivalent. So I'm just talking about certain oft repeated terminologies which you would be using in your day-to-day operations. The only thing is IPEF provides a framework of how to bridge the gap between all of these. In the sense, you can take your investment round and move it forward to your valuation date rather than valuing it as of the date of investment. Uh, based so this session, what we are also trying to do is based on all our discussions with various CFO forums, we have tried to build together certain oft-asked questions. One of which is how to value startups, early stage companies where market peers, market approach might not be directly applicable. And in that thing, I think the main approach again would be the approach of calibration. You might not do a calibration from a market approach standpoint. You might want to do a scenario analysis. So what you need to do as a finance controller is that you have an investment by the fund as the starting point. So you would have to go back to your investment team, investment memos, look into the thesis based on which the investment was done, try to build a framework justifying the thesis of investment. Like Rishi highlighted, you would want to look at what were those unobservable inputs and then try to move forward from your date of investment to the valuation date. rather than just holding it to cost or just holding it to the last round of finance. You would have to look into how the market has evolved, how the company performance has been, uh, and capture all of this into your analysis. So that is what IPEV would outlay. IPEV does highlight one thing though, that price of recent investment is not a valuation technique. It's the starting point. So even if you have invested, let's say a couple of months ago, as a controller, you would have to put certain checks in place to see if there are any major changes in the business, see if there are any major changes in the market that warrant a change in valuation. If they don't, you can continue to market to the same price. However, there has to be a framework and a rough model that backs to your valuation. Also, one thing which is kind of important from an AIF regime standpoint is that the AIF regime warrants valuation of all your investments, irrespective of the materiality threshold or the time period, which means you will have to look into fair value each and every investment. The detail and the methodology would differ asset to asset, but you would have to cover the entire portfolio that you are looking at. Other than this, over the last couple of years after the increased funding rounds, what we have come across is that the investor methodology or investor viewpoint, market participant view, has changed from a growth driven market to a market which is focused on profitability. And in this case, one of the oft asked questions has been around cash burn and how to capture that from a valuation standpoint. So when it comes to cash burn, the few points or the few questions that as a controller you need to look at is what was the reason for raising the funds? What was the expected path to profitability? And how has the company done? Is it still performing in line with expectations while burning a little more or little less? Are they building in better unit economics? If you could dive into the P&L, try to understand the margin profile, CM1, CM2 levels, that's something which is important from an early stage investment standpoint. The reason being, most of the early stage investments tend to be cash burning at least for the first 3 to 5 years where they are raising rounds of funds. So instead of looking directly at the bottom line, it's also important to look at unit economics at various levels and see how the company has performed. Another important thing that you would want to look at is how much of a cash runway does the business have? Is it sufficient for the business to achieve certain major milestones, be ready for the next round of funding, or are they going to run out of cash? Because all these would have to be captured into your analysis when you are doing a valuation. So valuation is not just a quantitative uh, model based analysis, but also a qualitative analysis which needs to capture these things. Another off asked question was around what if we are the first investors into the business and there was no other price discovery? How do we value the business? Uh, to that aspect, I would also want to highlight the same point being the fund investing into the company is a market participant. And if the round of investment follows the basic principles of fair value, which is there's a willing buyer, willing seller, there was a consideration paid, and a sort of diligence done at the fund's end, the entry point becomes your starting point. You might not be following the traditional approaches, but your deal team, your investment team would have set across certain expectations from the investment. Those expectations can be converted into a framework for valuation moving forward. It can either be a scenario analysis based on the expectations of the investment team, or it can be a market approach based on a broader industry. But looking at that transaction, building a framework around it, and moving it forward is something that IPEV tries to give you out as a framework. So the underlying factor of IPEV is not to change valuations in entirety or provide new techniques to valuation, but to provide a framework that helps you move from your date of investment to every measurement date till the exit. Uh, Also, one more aspect that I would like to highlight in terms of valuing for private equity is the fact that you are valuing it as of a measurement date, but not from a deal standpoint. So it's not a pre-deal valuation, but more of a valuation for reporting purposes based on data points that are available to you as an investor. So that is the whole framework based on which IPEF has been built in, and that covers the main aspect of calibration. The valuation methodologies remain the same. Is the calibration that is the important aspect in terms of private equity valuations. I think Rishi will take over again for private credit.
Thanks, Suresh. So thanks very much. I think what you saw on the last couple of pages were actually questions asked by a bunch of funds on their early stage investments, and then situations where little data was available, and then cash burn situations. So that's what we tried to cover. On the private credit part, what I will mention is it really is essentially a two-step process, right? This is a fundamental bottoms-up approach. We're looking at what was underwritten, what the investment thesis was, right? This is similar to direct lending that happens, let's say overseas in the US being the largest market. Then how has the lender assessed the borrower? All the typical classic uh, credit considerations of capacity, collateral, character, covenants. Or is this a special sits? And what is the security that we have issued? Exactly understanding all the features, whether there's only debt or there's even like some equity-like components in that, right? So the first place to start is through that, and ultimately first understand, as I mentioned, two-step approach. To first understand what's happening at the company level, when it was underwritten, and then using the same calibration framework that roll that forward to the measurement date, right? So starting with starting with setting up a framework for when we invested, right? What was the collateral at the time of underwriting? Is it backed by cash flows? Is it backed by assets? What is the timing of those to kind of ramp up eventually to kind of make whole our return expectations? How will the exit for this particular instrument be realized? What's the loan to value, and what should be some thresholds we think of, right? And then, as I mentioned, a calibration forward means rolling this forward to the valuation date. Again, whether this is performing debt or non-performing debt, or special sits debt. Thinking as applicable then to think about the different things you need to look at compared to what you underwrote. Right now, we do look at, for direct lending, we do look at market spreads, but I want to caution and mention that the private credit strategy was developed as an alternative strategy to more mainstream investments, and it was it is a strategy that has been adopted and rolled out by a lot of borrowers that have yet not been able to access public markets or bank loans. And so the correlation of this strategy to those to the public markets and the credit markets has been historically very low. Of course, we look at credit markets and we look at see how those have moved, but it doesn't necessarily move in lockstep manner. What's more important is kind of how you've underwritten it, and what is the quality of the collateral, the path to realizing liquidity from that collateral. And so even on a direct lending standpoint, there needs to be some kind of uh, you know qualitative assessment as to how the public market broad indicators are kind of impacting your analysis, right? And then with special sits, it's obviously driven by what events have you underwritten? Is it an IPO? Is it a cash crunch? Is it working capital financing? Is it acquisition financing? Is it stabilizing an asset? All those kind of situations, right? And so then moving on, all of this needs to be modeled out through either a yield analysis or a recoverability analysis, right? Both of those would have a certain return attached to a certain future date, and then an appropriate discount rate, which then you take back and you rerun this whole analysis as of a valuation date. Just a little bit more, if you go to the next page, Savish, just a little bit more on a more performing debt challenge, which is you made this investment. Think of calibration as Savish just pointed out. Like you're observing changes in the spread that you're backed into. You're observing changes in the underlying rates as well. But then, are you observing the changes in the lender, or sorry, the borrower that you expected to see? Which is, did you expect, have the underlying cash flows and profitability kind of ramped up to the level that you needed to observe in order to be comfortable that your loan is covered, not only from a leverage, not only are you comfortable from a coverage standpoint, but also from a leverage standpoint. And then, if you're not, then what does that imply to the discount rate? If you were to do, again, a hypothetical transaction as of this measurement date, would you pay the same price to enter that position, right? So when you're thinking about discount rates for you in direct lending, you do understand that we do understand that it is not correlated, highly to the public markets, but you do have to go through all the key events that I've just kind of pointed out and that are laid out on this page. So we'll get into this in a bit more of a hot topic discussion. I thought we'd just bring up both of these aspects as things that have been brought up by attendees in advance or in past discussions with CFO forums. And just coming back to some of Sarvesh's questions, I think to Sarvesh's section, I think there were some questions asked. One of the questions asked was, a transaction happens at 30% less than where we're marking in our books. Is this a conscious markdown to be reported to investors separately? Is how the question was framed. The new SEBI guidelines do ask for, there is a threshold above which, an explanation needs to be provided. But I'd actually start off on another foot, which is to say, well, if a transaction happened, at a different, 30% different from where we're marking it, do we understand, why that is the case? Do we feel that, that transaction represents fair value if we kind of double click on and understand motivations, the participants, the pricing, the structuring? If we have all the information, perhaps we need to think about where we're marked and be able to triangulate that for starters, right? And above that, I'll defer to IVCA on the call as well, but there will be kind of some disclosure that will need to be made for the latest guidelines by understanding. So that was one question I saw. The other question I saw was, is fund is investing in early stage startups? Are we expected to get a valuation? Is the fund expected to provide valuation reports once every 6 months on audited financials, or can the valuation report be based on provisional financials? So we'll get to that in the hot topic, but of course, we typically see, and that's the first hot topic that we have, which is the use of audited financials. We typically see audited financials only once a year, right? We're not seeing it more often. I think it's a two-part question. The first part is really how often do I need to provide a valuation to my investors? And the circular used to have, you need to do this twice a year, unless you get a pass by 75% of your investors by value, and you can just do this once a year, right? That was part of 6 months versus 1 year. But when you're talking about being in compliance for the performance reporting, you need to do it once a year based on March 31st audited data in order to be compliant. So those are kind of two separate things which you can combine or keep separate, but that would be my answer to it. And so now getting to using that particular question to kind of get into a hot topic, which is IPEV actually has a paragraph that talks about the trade-off between what's available information, and how relevant is that information, to use in the valuation analysis. It's almost always going to be a lag between the valuation date and the latest available information if that timeline is short, right? And AIFs have to meet timelines for their investor reporting as well as their tax calculations, 64C, 64D, and this will need to happen before audited financials are available. I don't think there's anything in IPEV that says you can't do a valuation unless you have audited financials. Our recommendation would be to prepare the valuation analysis using the latest available information. Meet your investor requirements, meet your regulatory requirement for your tax requirement calculation, your tax calculation requirement. And then, this is going to be a process that's going to be refined. I think this is the first time we're putting this in action, right? Look and see how the information has come through the audited financials have come through compared to the MIS information that you have, and use that to inform yourself on the quality of information you're getting from a portfolio company, right? Again, I'll defer to IVCA to get into the regulatory aspects, but essentially, I think the answer is, when you get the audited financials, you should check and see how that kind of compares to the information you were relying on. Oftentimes, the valuation analysis may not use a historical metric, but certainly it will give you confidence in forward-looking information, and that's what valuation should be, a forward-looking concept. So that's topic number one we want to talk about. The next one, you can move to the next one, Savish.
Yeah.
So I think Savish has talked about this. Savish, maybe I'll jump into it for sake of variety, and then you can take the next one. I think I mentioned this at the start of the call. I don't think we need to spend a whole great deal of time on this. I mean, essentially, I think what we've been talking about, even on the valuation policy, is that you need to have a person or a team that's separate to the investment manager, that is essentially reducing the variables that are being tracked on a particular deal, bring together a skeletal model, that tracks, performance from, a last financing round or from the entry price, so that you can kind of calibrate and move that forward, right? It isn't really, I put the last paragraph to be pretty deliberate. This isn't a mechanical exercise, right? If you entered the deal at 10 and the market was at 12, but the market has moved to 15, the question is that 3x increase in the market, as an index, how much does that apply to you, right? What is the state of your company, and how do you triangulate your performance to that? And are you kind of fulfilling the underlying thesis that you signed up for, that kind of drove the fact that you entered at 10x, right? Of that multiple instead of 12. So, I think what's not acceptable is just saying last financing round because it's 12 months. I think I've gone over this plenty. I'll just park it here for now in the interest of time, and then move forward. Suresh, maybe you want to take the next one?
Yeah, I think this was one that Rishi covered earlier as well, which is how to think about unlisted, non-traded, or thinly traded securities. I think one of the critical aspects is the SEBI's master circular talks about using the MF regulations only for listed securities, and other than listed, if it's an unlisted security or a listed security which is not traded or thinly traded, you have to cater to IPEV guidelines. And when you look at IPEV guidelines, they talk about a similar framework that we talked about, which is that if the instrument is not traded, you would try to look into the fundamentals. You would look at it as a equity interest or a debt interest. You would try to calibrate it. You would look at your investment thesis. You would see how the investment was made, build a framework around it, calibrate it forward. At the same time, it's also good to see if there are any quotes available. If there are quotes available, you would have to see what is the quantum, what sort of security is being traded. Is it the same security that you hold? Is it the same quantum, or it's a very small trade in that security? So it's very important to see how those market trades are happening. Are they of the same quantum as that of the investor? And also, it's very important to understand that AIF investments are bespoke. The investors are looking at tailor-made securities. These are not similar to other listed securities. So you cannot, for let's say unlisted bonds, you cannot take the listed bond yield returns and apply it to a bespoke credit facility which has been given by a private credit fund. Rishi, feel free to chime in with any other inputs you had on this.
Yeah, thanks, Savish. I think it's important to understand that we read the mutual fund valuation norms, and they refer to a bunch of traded activity and lot sizes, and people point to IPEV and say, hey, look here. Also, they talk about observable trades and actively traded markets. look, we first need to step back and understand what it is that we're valuing, right? We're valuing unlisted securities, private securities that have been, that are the outcome of bilateral bespoke conversations between the borrower and the lender. Right? They may get rated, but they are not intended to trade, so they do not trade, and the market participants do not expect them to trade. A transaction can happen, and a transaction can happen. That's a value. It's a great reference point at some point to understand if it got syndicated. But we are nowhere close to a large market where lots of these instruments get syndicated, and then there is a transaction between somebody and you have a broker that you can call. So we have to understand the context behind how IPEV was written, and the fact that it can point to some active or observable trades. But we're talking about in the accounting framework, level 1, level 2, and level 3 inputs to value assets. Level 3 being private assets, which is the whole scope, most of the scope of the AIF world. Now, I won't say that you have AIFs category 1, category 2, and category 3. We know the category 3, more of the hedge fund strategy that invests in the liquid securities. But what we're talking about for all practical purposes here for the applicability of IPEV is on private unlisted instruments, issued by private credit, and those are not always standardized. They're not marketable, right? They have structures. They often have equity-like components. They often have embedded options. To say that there's some trading volume of other issuances, you broaden it as you want. We've seen comparisons of the waterfall approach and the polling method, but those are using other securities and other issuers as it broadens, or calling other people that hold the same instruments. That is not applicable in the private space, where you actually need to track, as we mentioned, the fundamental performance, that's servicing those loans, and then the instrument valuation and how that needs to be thought of if we have to go back, if the private credit issuer had to go and issue something in the current environment. So there is some, I know there was a fair amount of conversation on this. SEBI also released a consultation paper in summer. Eventually, what led to feedback and clarity on the fact that private credit that we're talking about in the AIF space is starting with mid market, and of course it does go to the larger entities, but it's not the larger listed space that predominantly where the mutual fund valuation norms apply. Of course, the mutual fund valuation norms have listed, and then unlisted there are certain categories, and then there's below investment grade. But I don't think the private credit world thinks of it as below investment grade. It thinks of it as companies where they can get a particular required rate of return that are yet not ready for the public markets or yet not ready for a bank. So that's the distinction that I'd like to point to out. Thanks, Harish. Maybe we move to the next page.
I think the last and the most asked about question is around discount for lack of liquidity. And everyone, when you do a valuation as of a valuation date, you would tend to think of adding an additional layer of discounts because you're doing a market approach or you're relying on public bonds. And then the discount for liquidity, because you can't sell private investments as quickly as public investments, is something that gets questioned most of the times. In this regard, what we would like to highlight, and which even IPEV pointedly mentions, is that once you build out the framework of calibration, what it tends to highlight is you're starting from a price point where a market participant entered the investment, which means there was time taken to close that transaction. So the implicit liquidity discount for time taken to close a transaction already gets baked into the price of the entry point or your entry multiple. So when you're calibrating that forward, your discount for lack of liquidity is already baked into your multiple, and there need not be a separate layer of discount for lack of liquidity. The only reasons where you would apply such a discount would be when you look into the calibration point and see that there have been major changes either in the market dynamics, market participant view, or the company has pivoted and the company business has changed completely from the last round, in which case calibration is no longer possible or applicable. And in that case is the only point where IPEV says you would go ahead, look into public com benchmarking and then applying a dealer. Otherwise, most of the times it says that you select a comp set, select a set of comparable companies, use the same set of comparable companies such that the entry point captures the discount or the premium to comps, and you are calibrating the discount or premium. You're not going as of a measurement date, selecting the average or the median of comps, but you're calibrating the premium and discount and selecting a multiple which already bakes into the discounts, and no separate additional discounts are to be. So I think Rishi, those were the main points or hot topics that we had. I know
Yeah,
we
I
are
mean,
on time, but yeah.
yeah, I know. I think we could go on for hours on this, but whether people get bored, right? I don't know. But I think there's a bunch of Q&A that involves regulatory questions. I will defer to
Absolutely.
Rahul and Rohan on that.
Yeah, sure. So I would like to also welcome Rahul Shah. He leads advocacy at IVCA into this session. And thank Rishi and Sarvesh for taking us through at least the principles of valuation and how do we approach when we think about valuation for portfolio companies and assets. So thank you so much for that. Most of the remaining questions from a regulatory perspective, Rahul, are towards reporting in the sense of reporting to benchmarking agencies, reporting to investors, and whether audited financials are required, and the timelines with regards to the same. So I would like to bunch these questions and understand maybe from a guidance perspective, would you like to guide the audience in terms of how do we approach such nuances in terms of intricacies of reporting to various agencies and investors?
So, Rohan, why don't you just take question by question? I mean, if there's
Sure,
specific,
sure.
let's address that way because you are
Yeah.
you're asking 5 questions in one go.
Yeah, so the first one is, do we need valuation of fund as well from registered valuer?
Yeah, so I don't know. I think it's valuation was scheme wise. If under one trust, if there are 5 schemes, each of the 5 schemes have to be valued as per SEBI. So I know what a fund means in that sense. Each fund is a scheme where you raise money and it has its own tenure and its own PPM. Each PPM, one fund, one scheme, one valuation. That is the norm to be followed. So I'm not able to understand is the person asking a fund as a trust level or the fund and stroke scheme for me is the same term.
Sure.
And whether he's using the fund or scheme doesn't matter, but it has to be a scheme stroke fund wise. Every PPM requires a valuation report. Whatever he's doing reporting to SEBI is fund or stroke scheme wise. Same thing applies to valuation.
So Rahul and Rohan, if I could jump in from a technical standpoint, because somebody had asked us this question once.
Yeah.
I think somebody once asked us the question whether once the portfolio investments are valued, whether and that's kind of rolled up into the fund NAV, whether a registered valuer needs to then review that NAV calculation. But I mean, we didn't perceive it as anything that was addressed in the SEBI circular, nor did we think also particularly that it involved a lot of subjectivity. So that's been our response, that we're not aware of anything from that angle, if that's what the question refers to.
Sure. Yep. So we move on to the other one now. For the benchmarking report to be sent end of October, the valuation needs to be done on the basis of audited financials. So if there is a change in any of the metrics that was considered for valuation, say revenue, should we make changes in our valuation for the purposes of reporting in SEBI QAR as well? They're talking about the monthly quarterly activity report. In my understanding, the following QAR they submit, they probably need to. So it needs to be based on, the latest financials that the fund is undertaking. So the QAR needs to be updated based on latest financials. So it needs to be updated.
If the particular quarter is already gone, you don't want to rectify it. But going forward,
Yes.
use the latest valuation report, latest quality reports available for going forward. Don't have to go back. If you have already submitted a June report, you don't have to go and change the June-September report, and you just move forward. And
Yeah.
when you are going forward, give the latest figures.
Absolutely. We move on to the other one. The question is, while reporting to benchmarking agencies, valuation should be done based on audited, statements of investee companies as per recent SEBI regulations. But by the time we procure valuation report, audit of our investee companies will be in progress, as due date for issuing valuation report to investors is 30th September. Do we need to procure 2 valuation reports for the same period?
So again, I think it's a call which you and your management board has to take. Regulation doesn't talk about where and how we should respond to your investors. If you have a commitment to make to your investors and you want to stick to it, it's a call with your management, the fund management and the board has to take what you wish to do. But as far as SEBI concerns are concerned, they want audit of the investee company. The evaluation will be based on audit of the investee company. And I presume the audit of the fund has to be based on the valuation report. So if the timings are not able to match, it's a call with the management to take. I think SEBI doesn't give any direction on that matter. So it's for you to, the manager itself to take what it wants to do. And do they want to take valuation report? It's a management decision, I would say, not a decision required by regulations.
And I think the answer to this question is also the same. As per regulatory framework, within how many months/days do we need to provide the fund valuation report to the investors? For example, let's say the measurement date is 31st March, then by when do we need to provide the valuation report to the investors for the said measurement date? I think it's a call that is taken by the board, and it is given down in the PPM that within this much time frame beyond the measurement date, you are going to report to the investors.
Yeah, it's all depends on your PPM. Right? Again, SEBI doesn't talk about anything or reporting to investors. So I think whatever your PPM says, you have to adhere to it or take concession from the investors if you want to delay it in that sense. Again, it's a more of corporate governance and issue within the manager itself has to take it up.
Sure. So I think this one is for Rishi and Sarvesh, perhaps the last one. What are the valuation methodologies that can be used for valuing investments in startups early stage other than DCF and no other market data is available?
So I can take this up and Rishi can add in. So the main thing, like rightly mentioned, startups, you can't do a DCF because you do not have projections. But like I was highlighting, there's something called as a scenario analysis. So when your investment team is doing the investment, they would have certain expectations from the investment. Those expectations can be converted into scenarios. There would be a downside protection, there will be an upside expectation, there will be a base case expectation. Those sort of scenarios can be built in and done using a probability based approach. Or you can also, if it's a very early stage business, it's more of a qualitative analysis where you use a milestone approach where there are certain milestones that the business has to achieve. This is for pre-revenue businesses where you don't have a financial metric. And then the value creation would be entirely based on what all milestones need to be achieved to reach to the next level of financing. So for early stage investing, valuing using a market approach is also helpful, but otherwise building a scenario or a milestone approach is always recommended. Rishi, feel free to add it.
No, I think you summed it up, Suresh. I mean, I think it's worth emphasizing that the guidelines have evolved to understand that investors are getting more sophisticated to look for that additional alpha. They've gone to different strategies, and especially earlier stage investments has been something that's been, very early stage investing has been pretty prominent for the last 20 years. I think they understand that it's uncorrelated, very lightly correlated to the markets, right? The closer you are to a company that is getting to an exit scenario in the public markets, naturally at a later stage you will find it to correlate more to the valuations to correlate more to the public markets, right? So one is the challenge of A, what do I track? B, I don't have maybe in very early stage revenue, maybe I'm very let's just say very early stage revenue because I'm not even going to get to profitability yet. A very early stage revenue. And then you have to sit with if you're a CFO asking this question, then you should sit with your investment team and say, okay, what did we underwrite? And we're not obviously we've seen investors and how they behave, and the fact that they issue capital, for the most part issue enough capital to achieve certain milestones in order to then develop to the next stage or next phase or the next round of funding. But nobody's sitting and saying, I'm going to put down all this capital for this company. Well, it does happen sometimes. But the vast majority is not sitting and saying we're going to invest capital at this stage to get through 20 real option scenarios to get to a public market situation. You just have to track what's going to happen in the next few years or till the next few events that take place, and essentially you underwrote to get the next round of funding at a much larger scale, more revenue in the bank, a better product market fit. Then you're tracking, revenue. You can look up IPEV, you can look up section 3.10, you can look up all the milestones that it tracks, and then you should have a framework as to what you think is more relevant, because essentially I would think a lot of investors will tell you before Series B, you can't really just do a math model on the financials. You have to consider a lot more of the intangibles that you underwrote. Hopefully that answer helps.
Yeah. Next two are also for Rishi and Sarvesh. One is on calibration premium. Is there any flexibility in changing the initial calibration premium, especially for high growth companies where sometimes applying calibration premium results in inflated valuations for these companies?
Yeah, I'll start. I mean, so jump in then. I think great question, and IPEV speaks to the judgment and the discretion of the valuer in how to roll forward a premium, from a particular round. If you paid for that growth, you paid a higher than market multiple for that growth, and you have achieved that, and you are mostly through that process, then most of that high growth period is past, and what you've underwritten has taken place. Arguably, the companies at a more mature stage, you should have you should have amortized that multiple to reflect the fact that you have passed through most of that high growth phase scenario, right? Era. So the short answer is yes. Again, IPEV is principles based. It's not going to tell you this is the calculator to use. You're going to have to observe what takes place both in the private markets as well as in the public markets. The private markets are especially more correlated to what a lot of pre-IPO investors will see, right? Because it's entirely about what are the transactions that are taking place in the market, and there also you'll have limited data availability. But in many cases, you can observe and see how multiples trend across your competitors across their different life cycles. So that's what I'll point out. Savish?
I think I'll just add one more point to the other end of spectrum. Sometimes these premiums are paid for growth or paid for a part to profitability. If your business is not tracking in that sense, even then you can reduce your premiums, because the premium is paid for a reason. So you need to track your business whether the premium is still justified compared to market. Are you still performing ahead of the market, or are you performing in line with market or behind market? So that also serves a decent enough reason for changing your discount. So I think IPEV does give you that much flexibility.
Next one is investment. If for any investment, we have provided for 100% provision for diminution in value of investment, whether in such case valuation required to be taken from registered valuer.
No, it's a great question. I used to face this challenge when I used to work within a fund environment for a couple of years. That some principal used to tell me, why are we valuing this investment? This private credit investment is mostly written off. So we used to have, I think it comes back to the valuation policy question, right? What is the threshold of NAV that we need to look at? And what is the threshold hinged on? Is it on the committed capital that we put to work, or is it on today's fair value, right? Because if you put in, this investment was at one point, 10% of your NAV, and now you've marked it down to de minimis. That's a policy decision that your board and your valuation committee needs to take, right? But if you clearly think that it is a very simple analysis because the state of the company is it's in wind down and there's just cash, then it's a very quick discussion as well, right? So nobody's saying we need to create like a big fat report on it. It's just capturing sufficient documentation and, if needed, sufficient analysis.
Sure. So with that, we come to the end of the Q&As. All right. So I think what we could do is, if there are any more questions that the audience has, do write into IVCA. Our coordinates are there on the IVCA.in websites, as well as we would like to inform you that every aspect of whatever SEBI has prescribed and the communications that we have done in terms of our meetings with SEBI and some of the clarities that we still require as an industry, and IVC has represented to SEBI that we need so, are all present on the IVCA's advocacy web page. So do visit that and do go through all the PDFs that we've uploaded there for your own clarity. And do write into us whenever you have any doubts. With that, we would like to end the session. So I would like to extend, Thanks from IVCA's and the industry's point of view to Rishi as well as Sarvesh. Really appreciate the time that you took out today and shared your perspectives on these intricacies of valuation. And we look forward to having you again, maybe in a frequency-based manner in future as well, in another webinar where we could delve into other aspects of valuation as well for the industry's point of view. Thanks to Rahul as well for joining us. He leads advocacy and he's been leading the effort in terms of getting these clarities and engaging with SEBI on these aspects of valuation. So thanks to the three of you, and thank you everyone that you could also take out time and attend this important webinar, and hope this important information actually gets disseminated in the industry and there is clarity in terms of these aspects of valuation that SEBI has prescribed. Thank you to all of you. Thank you so much.
Thanks, Rishi. Thanks, Sarvesh.
Thank you.
Thank you.
Thank you.